Right. So here's what we're gonna do. So I think it makes sense to kind of just go in order, really start talking about why we like the market and why we think the market goes higher from any sort of intermediate term standpoint. The weight of the evidence is suggesting that if we're going to be wrong, right? Because we're going to be wrong all the time. But if that's the case where we're wrong, we want to be wrong by erring on the long side of buying stocks, right? As opposed to being aggressive on the short side. So Sean does a really good job of putting together income trades where we can kind of just generate income and take advantage of that the decay in those premiums. So we can either incorporate those sort of strategies or incorporate kind of more directional sort of trades where we think things are going higher, right? So that's sort of the strategy that we want to err on. And I think it makes sense to kind of just go over a few markets and kind of show why we think that. So first of all, this is the Russell 3000 index. So this represents approximately 98% of all the investable assets in the US stock market. So if we're making new all-time highs in this index, it's just really hard for me to be bearish of equities, right? So these are the early 2015 highs, excuse me, the 2018 highs. As long as we're above those levels in the IWB, I think we need to certainly err on the long side. So 169 there. If we start falling below that and we start seeing some failed breakouts and things like mid caps and stuff like that, that would really that would be evidence of kind of maybe some short-term deterioration in the stock market. And I think that's certainly possible as we enter kind of the latter stages of the summer, those summer doldrums. And we can have maybe a little bit pickup in volatility with some in an illiquid market environment, which is typical of the end of the summer. Like, that wouldn't surprise me. But from any sort of structural perspective, I think we need to err on the long side going into the end of the year. So a couple of just kind of myths. Sean, how much are you hearing, this market breadth deteriorating sort of mantra? Are you getting that a lot on your end?
I see it being bandied about on Twitter, yes.
I mean, just to keep it simple, stupid, a couple of easy ways to keep an eye on market breadth. The advanced decline line keeps making new highs, but that's not even the case, right? What we're looking for, so here's the advanced decline line making new highs, and the S&P 500 still has not made a new high. But what we're really more concerned with is if the S&P 500 is making new highs and the advanced decline line is not making new highs and putting in lower highs like it did in 2007, right? That sort of divergence is what we call deterioration in market breadth. So getting back to what we're seeing today, yes, we're making new highs in the advanced decline line, but that's not even the point because the S&P 500 isn't yet, right? So we're not even in a position to even suggest deteriorating market breadth. And then another common one, easy to see, is the list of stocks making new 52-week highs, right? So yes, are we seeing fewer new 52-week highs than we did at the beginning of the year? Yeah, sure. But guess what? We're also not making new highs in the S&P 500 yet, right? So what we're looking for, here's an example of 2007 when we made new highs in the S&P 500 into the fourth quarter of 2007. We had a deterioration of market breadth. We had weakening participation, fewer stocks on the New York Stock Exchange making new highs, right? That is the deterioration in breadth. What we're seeing today is none of that at all. Now, could we see that deterioration in the future? Of course. So if the S&P 500 starts making new highs and we are not getting an acceleration of participation in stocks making new highs, then we can have that conversation about a deteriorating sort of market breadth. But we're just not there yet, And then finally, the yield curve. Sean likes to stick to his stocks, right? JC, give me the stock chart, and we can come up with cool strategies. Bonds, you stay away from, huh?
I can't even pretend to understand what this chart's telling me.
Well, I we complement each other very well because the bond market is very important. This is where we get a lot of information because people talk about crypto market. Crypto market is this little irrelevant nothing, right? Like, nobody with real assets can participate. In the stock market, there are a lot of stocks that even still, even the most liquid stocks, it's difficult for the largest institutions in the world to really be an active participant in, just because they have so much money that for them to put on a position, they would basically have to buy the entire company, right? Which they're not in the business of doing. So the largest financial institutions in the world have to be in the bond market, which is the largest market on earth. So if you really want to see what sort of risk appetite versus risk aversion sort of scenario you're getting from the biggest money on earth, what actually moves markets, you got to look at the bond market. Just basically is free information. You know, you're going to get a lot more information from what's happening in the yield curve and in the bond market than you're going to get on the cover of your favorite newspaper or on whatever TV show you're watching on basic cable, right? So here's the twos tens, right? So the twos tens is probably the benchmark yield curve, and basically the point of this is that just because we are getting a flattening yield curve doesn't mean the stock market needs to fall. In fact, to the contrary, when the yield curve is flattening historically, the stock market does well in that environment. So the fact that the yield curve is flattening, that's fine and dandy. The fact that stocks are doing well in that environment is perfectly normal. Stocks are supposed to do well in a flattening yield curve. It's years or 6 to 18 months after the yield curve inverts that the stock market starts to kind of participate to the downside, and we get the recession, if you will. And then just to show you, it's not just the twos tens but the ones 30s. You have any questions on that, Sean? Is that clear? How'd I do?
Yeah, let's just move on.
You're hilarious. All right, guys. Bond market says we're in a risk-on environment. And same thing with junk versus treasury. Sean, think about it, dude. Think about it. If you're an institution and you think that the market's going to go higher, you are more inclined, and you're aggressive. You're more inclined to be buying junk bonds than you are U.S. Treasury bonds, right? So
Absolutely.
that flow of risk versus risk aversion is an indicator of what these guys are doing. So if the market's about to really collapse and we're going to have a volatile period, you're going to start to see credit spreads widening out, not narrowing. So just by watching that, you could see if there's pain being felt out there or there's not. And right now, we're in a very calm environment that is consistent with the stock market going higher. Is basically the point of that. So 3,000 on the S&P 500. Just want to show you the chart. That hasn't changed. That's still where I think that we're going. And then the Dow Jones Transportation Average. I know Sean is going to talk about CSX. Which is part of the industrials, which is also a big component of the Dow Jones Transportation Average. If we're above 11,000, if we're above 11,100, man, that we can start making a solid argument for a new leg higher in the Dow Jones Transportation Average, which, by the way, I know it gets confusing, but the 20 stocks in the Dow Jones Transportation Average are in the industrial sector, right? Which CSX also belongs to. So I think that would be incredibly constructive if the transports break out, because the industrial sector has the highest correlation traditionally with the S&P 500. So it's all consistent with higher stock prices. And then the NASDAQ composite, more on the tech side. Sean's going to talk about Google and what we're seeing in tech. But if we're above 7,600 in the NASDAQ composite, again, very similar argument that we can make to the Dow transports, where we can be at the beginning stages of a new leg higher. All right, so let's get into some trades. Before we get into American Express specifically, I want to talk about financials. Overall, what concerns me? People ask me, JC, what do you lose sleep at night, or whatever they say. These '07 highs in financials, we basically kissed that level earlier this year and have not surpassed it, right? So is this a massive double top in financials? I don't think so. I think this is just a consolidation and then we resolve higher. So that's kind of one thing that we definitely want to watch in financials. And JP Morgan is just a great leading indicator for that, right? Look at a chart of JP Morgan going back 100 years and overlay the S&P 500, and I challenge you to tell me which one's which, right? They look exactly the same. So I still think we're going to 136 in JP Morgan, which makes sense for financials and all that stuff going higher. So here's the American Express, Sean. I mean, I like it. I think that we're going a lot higher. The trade has been working, right? If we're above $100, I think we need to be long the stock, right? So then, what are you seeing on the option side, Sean? You got to unmute yourself.
Oh, sorry, I was talking to dead air there. I apologize.
No, no worries.
So we got a gift when we got into this trade. So we published our buy on July 30th, and that day when the market opened, American Express gapped down pretty significantly and traded down pretty hard, as much as $4 that day. So we were telling people you should want to be a buyer of the October 110 calls at $1.25, but we got a gift and we were very easily able to get filled. As low as I think I bought some at like 38 cents, but on average, people should not have had any trouble if they got into that trade with us that day. They shouldn't have had any trouble getting filled around, getting an average price in the 60s. So my average price is 66 cents, and And so we got a gift, and the stock has since rebounded. And man, if you look at that long-term chart, I mean, you had it up a minute ago. That baby looks like it wants to go, and we're positioned well for it. We got in because volatility was low. We just went straight naked call options, which is what I like to do when volatility is low. And a lot of these trades that we're going to go over here in the first part of this call, it really uh, goes to JC's thesis about how we are still very bullish on US equities. And when we're very bullish, coupled with a low volatility environment, and environments like that, you don't need to overthink it, JC, man. You just, volatility is low. That means premiums are cheap. Let's just buy calls. I know it's not sexy, but it's easy and it's effective. And you're going to see that on a bunch of these, at least these first trades we're going to talk about. So AXP, American Express, incredibly bullish. Positions starting to work. I think we have a good ride ahead of us. I'm hoping, knock on wood, right?
Yeah, it's interesting that you talk about that because when volatility is higher, it would behoove you to finance those trades by selling, another option, right? To be able to pay for that call, for example. But when volatility is low, where it is, and you're able to get such a discount on that premium because of the low volatility, just shut up and buy the call, huh?
Yeah, when volatility is high and you want to be long something, you got to be a little bit more creative because you don't want to overpay for options. There are more creative ways to do it, but it just adds layers of complexity. It doesn't make it impossible or hard. It's just extra layers of complexity. But man, when volatility is low and stocks are making new all-time highs, it really pays to just keep it simple. And sometimes just your good old friendly long naked call is really the best play.
So getting into industrials, like we said before, all of the stocks in the Dow Jones Transportation Average are in the industrial sector. I know I always say it's probably really confusing to somebody who's new to the market, right? Industrials, transports, which one is it? So in the industrial sector, that's where we have all the transports. So that's where we have the railroads, the truckers, the shipping companies, right, like FedEx and UPS, and the airlines. So the airlines are the ones that have been struggling the most. The leadership group in that area is the railroads. And by the way, Sean, this is part of the bullish thesis, right? If the Dow Jones US Railroad Index is breaking out of a multi-month base to new all-time highs, like that just those aren't the types of things that happen when the stock market is falling, right? That's consistent with higher stock prices. So CSX is basically just a better version of the Dow Jones US Railroad Index because it's the best one, you know?
Yep.
So what are you thinking?
Well, much like AXP, I mean, this is another one where we love the long-term chart. The options gods were offering us a gift with the lowest premiums in over a year. You just got to keep it simple. And we when I tend to buy long naked calls, I like to buy the 25 delta options. What does that mean, 25 delta? It means it's slightly out of the money. And for every $1 in movement in the stock, you'll see 25 cents of movement in the price of the option, right? And I like to buy 25 delta calls because to me, it's the perfect mix between lower premiums and opportunity for profit, right? Like I don't want to buy at the money calls because those calls have the highest premium and we don't want to pay a lot of premium. We want to we want to collect premium ultimately, right? So I like to buy out of the money calls. That's what we did here with the CSX, and these calls are starting to work, as you could see here. And one thing we like to do with naked long calls, and we'll see this with the XLV trade we got coming up, is that when I buy long naked calls, for me it's a best practice. I like to sell half of my position when I can double up what I paid. So these CSX calls, I think we paid $2 for them. So if I get a chance to sell them at 4, I'll sell half of my position at 4 because what does that do? That gives me a free ride on the rest. I'm not trying to be greedy here. I'm trying to be smart. And if I could have a free ride on a position where I've taken out all of my original risk capital, I'll do that all day long. And that's and CSX, another couple more days of the movement we've been having recently, we could be there.
And I want to point everybody because Sean makes that perfectly clear, and I like that you're always reiterating that, when it hits the target, just basically get out, right? Your mission accomplished, right? When you're getting back 50% of the premium, right? So you can go to allstarcharts.com, click on education, and here are all of these modules. And I think you did an awesome job, Sean. So I definitely encourage everybody, take a look at all of them, and you could really see, how we put on these strategies, and it really makes a lot of sense. In some cases, it's keep it simple, stupid. Sometimes you got to complicate it a little bit to finance the trade, but it's not the end of the world, right?
That's right.
All right, so let's talk about energy. Another area that we've kind of wanted to err on the long side. I still think that we're heading higher in energy stocks. This is XLE. So then oil, also more specifically, we think oil gets back into the 80s, but we also don't think that oil goes a lot lower either, right? Which is kind of where that USO trade kind of came to be. So I think at the very least, I don't think oil is going to completely collapse. I think that at the very least we'll hold this 62 area and really stay above that and kind of be in this 60s to 80s sort of range, right? That's kind of what we're looking for. So then on the trade itself, Sean, this is on the USO, this is on the ETF of crude oil.
Right. So the USO trade was compelling to me because of all the high liquidity, or at least when it comes to options, of all the ETFs I follow that have high options liquidity. At the time I put this trade on, USO was the ETF that had the highest uh, volatility. I apologize for the mistype there in the in the chart. I wrote high relative volume. I meant to write high relative volatility. So USO, it was at the upper end of its volatility range for the past year, not at the top, but certainly at a nice juicy level. And coupled that with the fact that the ETF has really kind of been stuck in a range for the past 90 days. For me, those are the perfect candidates for income trades. Income trades are trades that you don't want to have a big move in either direction. And you're not really picking a direction, you're just neutral on the trade, and you want it to continue staying in a range. So when I see ETFs, especially ETFs, when I see them at the upper end of their volatility range, meaning that options are having some pretty juicy prices, and the ETF is in a range, I love jumping into income trades. And so with the USO, we just did a very simple short straddle. So we sold the 14 strike calls and puts, an equal amount on both sides, and collected that premium. And the trade is so far working. And the goal on this trade is, and the goal on any time you should sell a short straddle, is we want to cover this position when we can buy it back for 75% of what we collected. We don't want to be greedy, okay? The longer the more time you put into this trade, the more likely, the more tempting you are to the market gods to wreak havoc on your trade. So we like to just kind of get in it and get out with some nice tidy profits as soon as possible. So we got into this trade with a $1.05 credit. We'll be looking to get out when we can get out around 75 cents.
Sean, why 75% in this case when in the other trade it's 50%?
Because we have unlimited risk in this trade. Our risk is not defined. If oil is a volatile commodity, as we all know, and if oil prices all of a sudden start surging because of who knows what out of the Middle East or Texas or whatever, we could see this ETF go from $14 up to $17 in really not that hard of a, and not that it's not hard to conceive of that happening. And as you can see from this chart here, if prices moved up to $17, we'd be sitting on a rather large loser, and that's a pretty uncomfortable position to be in. So when you have naked risk or unlimited risk like we do in this case and in all cases, I like to be more aggressive in taking profits, and I'm only trying to keep 25% of the premium that I put on. That's a best practice that will serve you well over the long run.
Yeah, and it gets back to resulting, right? Just because it's a negative outcome doesn't mean it was a negative process, right? It takes a long time of a lot of seeing that happen over many occasions over time to be able to see the actual results. And in this case, it might come to bite you once or twice, but over time it's going to pay off dividends, right?
That's right.
All right, so let's move on to healthcare. Sean, I like healthcare. It gets forgotten. I did Real Vision the other day when I was in New York, and they're like, all right, JC, what do you want to talk about? And I'm like, how about medical device stocks? And they're like, what? Like they thought that it was coming from like outer space or something, because that's just not something that people are talking about a lot. But I see healthcare here on a monthly basis trying to break out to new all-time highs. That's bullish where I come from. The concern that I have here is that we're kind of basically up to where things kind of fell apart in January. So there's still memory in this area for me. What are you seeing in the
Well,
calls?
that's actually perfect that you say that, and it kind of works out well for us because today, if you had gotten in this trade like we did at 76 cents, today you had an opportunity to get out at that double that I talked about before, where when you're long and naked calls, a best practice is to close half of them when you're sitting on 100% gain. And I was able to do that today. I was able to close half of my position at a buck 50 today, which means I now have a free ride on the rest. And you're concerned about that level. I'm concerned about that level too. But you know what? I don't have to worry. I don't have to worry about it now because the thing could go to zero, and hey, at least I didn't lose any money. But I got a free ride if we go higher.
So you're playing with house money at this point. That's not a bad position to be.
Exactly.
Love that. All right, so then more specifically within healthcare, you know, what's funny about medical device equipment stocks is that it doesn't really care what the rest of healthcare is doing. Healthcare is a very broad thing. You got pharma, you got managed health, you got biotech, you got all these other things. But medical device, I feel like it's more like it trades more like technology, which I suppose makes sense because that's what it is. It's technology. Because it looks like technology stocks, right? I looked through my technology workbook, and that's what these stocks look like: Adobe and all the software stocks and things like that. So I think medical equipment looks great. We want to be long this area for sure. And then Medtronic, to me, just is just one of the names that I see with one of the best risk versus reward opportunities. We hit our target, consolidated for a couple of years, and now breaking out again. I mean, if you ask me, that seems pretty damn normal. You talk about the November '95 calls. Seems like that's like a ways out, right?
Yeah, again, I'm going to sound like a broken record, but with this low volatility environment that we're in, options prices are very cheap, and when they're cheap, it pays to just keep it simple, and especially if you could keep it cheap and you could go out further in time, which in this case, Medtronic November calls were really at very affordable prices. We were able to buy the 95 strike calls for a buck 35 when we were only I don't know, $4 away from that strike. And I mean, that gives us, I mean, what, 4 months for this to play out? And we got the $100 roll target sitting out there. It's a big fat round number. We all talk about the $100 roll all the time. If Medtronic gets to $100, which I can't imagine why it wouldn't, at the very least, we're going to be able to sell half of our position, right? And have a free ride on the rest. But if we get to that $100 roll, we're going to be sitting on a nice profit.
The way I see it, the way that we want to air, and we're going to lose money, right? That's part of the business, part of what, the deal we sign with the devil. We're going to be wrong. But if we're going to be wrong, and we got to sleep with that in our heads, I want to be wrong by being, bullish the strongest stocks within the strongest industries in the strongest sectors, have the probabilities on our side, not, obviously we have the risk reward on our side, but the probabilities on our side as well. I think that by being in the strongest areas right now, I think it's rather than getting cute, is the way I see it. So technology, speaking of the strongest sectors and not getting cute, I mean, just new all-time highs, right? So you can't really argue with that. Specifically within technology, Google has been a trade that, I've certainly liked. If we're above $1,200, we want to be long Google. I think we got over $300 of upside here. So I know you like you like the risk reversal, huh?
Yeah, Google, look, it's a trade I'm still very bullish on. I'm very bullish on the stock, but unfortunately, our August trade has run out of time. So if anybody who joined this trade with us, we want to be out of this trade now. Unfortunately, you might be sitting on some gains here. I know we are, and we're looking to get out of this thing ASAP because we only have 7 days of expiration, 10 days of expiration. Theta is our enemy here. the whatever premium is left in this trade is going to rapidly decline from here. I mean, look, you could be very bullish on Google, and if you want to roll the dice and think this thing's going to pop to 1300 over the next week, which is certainly possible, it is certainly possible. But uh, again, it comes back to that best practices, JC. If you do something, if you engage in these best practices, you make it a habit, you do it over and over again, over time, it's going to be a positive result. I mean, sure, we could close this trade today and Google could pop to 1300 next week and we'll all be pissed off that we left a whole lot of money on the table. But you got to stick to the best practices. And in this
But
case,
this is the second of the two Google trades, though. The other one worked out very well.
oh, we did have another August Google trade. We sold a put spread that, I mean, it was just a textbook. It hit our profit target, no problem. Never took any heat on it. Not even worth talking about, JC. It was a slam dunk win right out of the gate.
So made money on the income trade, made a little money on the risk reversal, but overall, I still like Google. Maybe we'll reevaluate at the end of this week and maybe come up with a new strategy going forward. What do you think?
Yeah, I mean, I still like it. I'm still bullish. I just, it's a bummer we're running out of time. But that, hey, that's the name of the game in options.
Yeah, no doubt. All right, so before we get into questions, Sean and I got together. We worked out a couple of good, trade ideas, I think. The first one is Berkshire Hathaway. So financials we're seeing rotation into financials finally, which I think is constructive for the overall market, obviously, of course, but certainly within the sector. And then Berkshire Hathaway has absolutely been a leader in this group, because Berkshire Hathaway, although it has, transportation exposure and things like that, at the end of the day, it trades like a bank. It trades like a huge bank. There's a lot, that's the largest shareholder of Wells Fargo. It has a ton of insurance and things like that. So it really trades like the banking sector. And the way I see it is that if we're above 200, we got to be long Berkshire, and we got 50 points to the upside. That's 25%. So I think it's pretty badass that Warren Buffett puts out his quarterly reports over the weekend, right? So we got a gap. The report comes over the weekend. We got a gap higher to start the week. So to me, as a technical analyst, when I see an important level like 200, which is not just a psychological round number, but actually the 261.8% extension of the 2015 to 2016 decline as well. So we get a gap above that. To me, I look at that as kind of like a gap and go. That's just this is the beginning of the move. That's a breakaway gap because the stock is breaking away from the consolidation, if you will. Man, I really like this one a lot. But before we get into the options trade, think about it like this, the S&P 500 and Berkshire trade very, very closely together. So if we're right on this breakaway gap in Berkshire Hathaway, then I think we're also going to be right on the S&P 500 going much higher. And in all likelihood, a lot of our long positions are going to do well in that sort of environment. So we're not just looking at Berkshire as a trade, but also as an indication of risk appetite out there.
Right.
So what's the move?
Well, the move is here is we want to be long for all the reasons you mentioned. And again, broken record, the volatility is cheap. So we want to be buying October 220 calls. The 220 would represent a new all-time high. The previous high for Berkshire is around 216. We're talking about the BRK.B options. Yeah. But 217 is the all-time high. We want to be long the October 220s. We can get them relatively cheap, but it's still, as a $200 stock, they're still kind of expensive. And so with that all-time high sitting out there at 217, I think at the very least that 217 area is probably going to act as some resistance or at least stall any upward move from here. So with that said, I want to be long the October 22 calls, but they're a little bit expensive just because it's a higher price stock. I can reduce my basis by selling September 220 calls against it, creating what's called a calendar spread. So I'm short September and long October. The play here is, my thinking is, I could sell those 220 calls in September. I don't think Berkshire will get through that level by September expiration. It might. I don't think it will. That's my bet. And those September calls will just fade away and expire worthless. That's great. And then that will leave us long the October 220 calls. at a cheaper basis than if we had just bought them outright. So that's a way to get long cheaper. But something to keep in mind is that if Berkshire does have an accelerated move and really does trade up to the new highs and doesn't even stop and to pause, it just keeps going. Well, once we get to 220, we'll just close the whole trade out. We'll have a profit in the trade for sure. We'll take the profit and move on, and no sense in being greedy. But I like this call, JC. I like that you're bullish, and I like, I like everything about it. I just think September, getting there before September is probably unlikely in my mind. That's why I like that we could sell calls against it and reduce our cost basis.
And that theta will accelerate quicker because September's closer, and then the October we're long those, for house money, hopefully.
Exactly. And for those of you paying attention, this is not a trade idea that we have published yet, but this will be, we will be publishing this idea in the next few days for subscribers. But for those of you on the conference call, you got a first look.
And then, okay, so we're talking about strength, right? Technology, semiconductors, all that stuff, not a secret, not anything new. But what I find, and by the way, these Fibonacci, I encourage you in that educational section that I showed you before, these Fibonacci extension levels have come into play in NVIDIA over the years. And I really don't know how would we be able to trade this successfully without looking at these Fibonacci extension levels. I mean, it's absolutely absurd. So the big level to me is 244. So if we're above that, I think we have to be long. So as beast mode as NVIDIA has been over the years, it's really done nothing all year, right? So the thesis is that we are, still in the early stages of a breakout in technology. We're still in the earlier stages of a breakout in the Russell 3000, which with another 6 to 7% upside. So in that sort of environment, the leaders that have brought us here, should lead us moving forward, and prices of stocks can consolidate and digest gains in one of two ways, either through a downside price correction or through a sideways consolidation. And the latter, sideways, is definitely the more constructive of the two. And that's precisely what NVIDIA has done over the last 7-8 months, right? It's consolidated sideways, not to the downside. To me, that is evidence of overwhelming amount of strength and demand relative to supply. The fact that they couldn't digest it by dropping the price, but by just kind of leaving it there for a while. So I think the resolution here is definitely to the upside. If tech's going to do well and semis are going to do well and stocks are going to do well, and I think that's what happens, and that would mean that NVIDIA is most likely going to do really, really well, right? So that's how I see that.
Yep, I agree. And so we're gonna play this one long as well. But there's a few things to keep in mind. Number one, and this is a rare occasion, or seems like it's rare compared to everything else we've talked about today. But the options prices and the volatility in this name is a little bit elevated right now, mostly due to the fact that there's earnings coming up in the next few days. But we're making the bet that earnings is going to be the catalyst that is going to cause NVIDIA to break out above 270. So we want to be long the 270 calls, and 270 would be a new all-time high. So we're making the bet that after earnings, maybe immediately after earnings, NVIDIA breaks through 270. But because the options premiums are high, I don't want to just buy a long call outright. I want to hedge my risk a little bit. So I'm going to sell the 300 calls against it. So that's what's called a vertical spread or a bull call spread. We'll be buying the 270 calls, selling the 300. So our upside is capped in this case. But you know what? It's lowering our cost to play. And I think that 300, much like I think it was Medtronic earlier, 300 is a big psychological number, right? It's the $100 roll, but in this case, it's the $300 roll. I think that level, if this stock gets moving, I think that's going to be a magnet. And whether or not it busts through 300, I'm not sure. But I think the premiums that are in the 300 calls right now should be sold. And so we are going to play it with a vertical spread to just kind of minimize our cost of participation, but we have a chance of making three times the money on our investment.
I like that exponentially greater potential profit relative to the risk that we're taking, right? I mean, that's the idea here.
That's right.
All right, guys. Well, listen, that's what we got. I try to present, sort of what I'm seeing from a technical standpoint. I think Sean did a good job of kind of walking us through, where we're at, on the premiums and everything like that. And we have a couple of good new ideas. If you guys have any questions, I encourage you to email us. You guys know, go to the options contact form. But for now, we've got a few minutes. If you guys have anything that you want us to rap about, put it in the questions, and we're happy to chat. So I like that technology, Sean. I really do. I think if
Well,
it ain't broke,
it's you're obviously it's no secret to anybody who's been following you. You've been bullish and you've been bullish for a long time. And hey, you've been right. And it bears out in the trades we've been putting on, at least in the options area, uh, by a factor of 99 to 100. I don't think we actually done 100 trades yet, but all of our trades tend to be either very bullish or the most bearish we've been has been neutral. We've been neutral on a few trades, but our trades have been predominantly bullish and they've predominantly been working out. Now, I'm not trying to pat myself on the shoulder, but what that tells us is that we've been bullish, we're right, and there's no reason to change that tune anytime soon until not only the markets, but the profits on our trades tell us otherwise.
yeah, and we'll be there. I mean, we've been there before. They used to call me a perma bear. I was that guy, and then I've been Mr. Rah Rah for years now. So now I'm a perma bull. People forget, and I'll be a perma bear again, right? So for us, it's just kind of it depends what sort of environment we're in, and we want to err in that direction, right? Because that's how we get the probabilities of success. So we're getting a couple of questions on the Tesla. Shocking.
Tesla. Oh man, I was so tempted to buy some calls in that thing this afternoon, and I'm kicking myself for not doing it now after it popped in the after hours today.
Here. So, I mean, for me, it's very simple. I mean, that's what we're looking at here, basically, right? So I think it should be expected that we're going to get this resistance here, which we have. Not a surprise, right? That's the 161.8% extension. We got a nice little failed breakdown here, right?
Well, I'm looking forward to all the Tesla bears on this call, listening to their jaws drop when you tell them what your price target is.
Well, I mean, listen, I think to me that this is a continuation. That's what this looks like to me, particularly with this failed breakout, because this was very key resistance that turned into support, right? Think about that, right?
Yep.
And then that turned into support, right? And it held, except for that failed breakdown, which makes it even more bullish. It's kind of like a slingshot. And I think we ultimately break out above those highs from last year, and we'll go above 500 bucks, and that's a long ways away. So our options trade basically hit our target in 4 days. Then pulled back, and now back up to these highs. Maybe we're not ready to break out just yet, but I think that the much higher probability outcome is an upside resolution, right?
I would agree with you, but yeah, very few on Fin TV would would share your sentiment, which is why it's probably good.
Yeah, I haven't, I'm not really a consumer of much basic cable. I like to look at my charts, listen to music.
Well, I just cut my cord recently.
Took you long enough. This is what I'm seeing in the Abbott Labs, right? So Jeff is asking us about Abbott Labs, kind of, what we're thinking here. To me, we're still pushing up against new highs, right? I'd love to see on new highs in price. I'd love to see momentum getting overbought as well. I think that would be really constructive. And on the WDAY, sort of a similar sort of pattern is what we're seeing in the workday.
Yeah, we've got a, trade. I think we have a trade on Workday. Yeah, we do.
Yeah.
Let me pull that one up.
We're pressing up against new all-time highs. We're up near the upper end of the range. And to me, the way I see it, this was resistance all the way across. That resistance turned into support, and now we're kind of on the upper end of that range. And if history is any indication, we should resolve higher and head up towards 160, right? That's how I see that.
Yep. Workday definitely has some work to do for us to make some meaningful money in that trade. It's still a good trade, and I mean, obviously, look at that chart. I mean, it's telling you it's just on the cusp of breaking down. And if it does, we got a long vertical spread on that right now in September. But yeah, we got time. We got what, 40 days, I think, until September expiration. A lot can
Yeah.
happen in 40 days.
Yeah, so these calls we wanted to focus a little bit more on the options that are expiring sooner, right? Maybe something a little bit more tactical, but something like this, it's moving in the right direction. Kind of, just let it play out, and this will be a September conference call conversation, right?
Yeah, well, then the nice thing about all of our August positions we're heading into August expiration is all of our August trades either hit their profit targets and we're already long gone in those trades, or they didn't work and they're just going to expire worthless. These were defined risk trades, and it sucks. There's going to be losers. There's always going to be losers. We had a couple of those, and then we just had that Google one that we were talking about that needs action. We don't want to be in that trade anymore. We're sitting on a small profit at this point. We want to get out of that because theta is going to rob us of whatever's left. So, but yeah, that's how. I mean, our August went pretty well for sure.
That theta will get you. I'm still interested in this Google, Sean. I think you and I are gonna have to, give it the weekend, see where we close for the week, and maybe come up with a new strategy. Because I definitely think this goes higher. But listen, if Nvidia is gonna do well, technology is gonna do well, Google's probably gonna, keep doing well also.
I do not disagree.
All right, guys. Well, listen, you got feel free to go and see how fast I can get down here. Boom. You guys know where to reach us. If you have any questions, shoot it over. Sean and I will get back to you right away. And for you guys who attended live, thank you for being here. And for you guys listening after the fact, shoot me an email and say what's up. Talk to you soon.
Take care.